Hello, my name is Derek Johanson, and I'm one of the partners here at Lazega Johanson. The topic of this video is understanding a community association income statement. Even if you are an accountant or are already familiar with income statements in general, please stay tuned, because there are a few things that I would like to highlight that are particular to community associations that may be different from other businesses in general. Basically, an income statement is an accounting and a financial report that associations use to track three things. It tracks money received by the association, called revenue. It tracks money spent by the association, called expenses. And it tracks the difference between revenue and expenses, which results in either net profit or net loss for the association. An income statement is typically run at the end of a month and reports the monthly financial performance of the association. But it's also run at the end of the fiscal year to show the annual financial performance of the association. And typically, the income statement is a report that members of the community association may review. If your community is managed by a professional management company, the management company handles the accounting and bookkeeping functions of the association in software that's specifically designed for community associations. If it is not professionally managed, there are software programs in the market that can be used to perform this task. In either case, the way it works is that every form of revenue the association receives and every item of expense the association incurs is given its own account, and all transactions that take place related to that item are tracked in that account. These are called general ledger accounts. For example, the association receives regular assessment payments from its owners, and these transactions are contained within a revenue account called general assessments. Likewise, the association pays a landscape company to maintain the common area of the community, and when it pays the invoice to the landscape company, that expense is tracked in the expense account called landscape contract. The income statement general ledger accounts should match the accounts you use in the association's annual budget. This way, you can compare the actual revenue received and the actual expenses incurred in each general ledger account to the amount the association budgeted for the year to compare how the association actually performed against how it expected to perform when adopting the budget. Typically, the income statement has the revenue accounts at the top of the report and the expense accounts at the bottom of the report. The net income or loss is reflected at the very bottom and is calculated simply by subtracting the total expenses from the total revenue. It is important to give general ledger account labels names that make sense to you as a member of the board and to owners in the community. Additionally, the general ledger accounts should be grouped together in sections of the report when they are related to each other. For example, if your community has a pool, you want an expense category heading in the income statement called pool expenses. Within that category, you would want several separate accounts that track the expenses of the different things you spend money on at the pool, such as pool permit, pool company contract, and pool maintenance and repairs. This way, when looking at the income statement, you can quickly find all pool-related expenses and their total, and you can easily see how much you spent on the pool contract as opposed to pool maintenance. If it is up to you to decide how detailed you want your association's income statement to appear, you can get very granular and come up with a lot of general ledger accounts for each and every type of expense you incur, or the accounts can be broad to reduce the size of the report. You should consult with your manager or accountant to determine how detailed your general ledger accounts should be. You should avoid using the miscellaneous revenue and expense account if possible. Sometimes something does fall into this category, but if you find that you're using it a lot for the same types of things, you know it's time to create a new general ledger account for that item with a good description of what it is and start recording those transactions in that new general ledger account. One thing that I'd like you to take away from this video that is unique to community associations is how to represent legal expenses incurred and any legal expenses recovered on your income statement. We recommend that the association have a general category of expenses called legal expenses. We also recommend that the association have two separate general ledger accounts within this category. One is for general legal expenses, in which legal costs are recorded that are unrelated to the collection of unpaid assessments from delinquent owners. These are legal expenses for things like contract review or governing document amendments or governance issues that the association does not expect to recapture from a delinquent owner. The second is collection legal expenses, in which legal costs are recorded related to the collection of unpaid assessments from delinquent owners. This way you can budget separately for these very different types of legal expenses and track what you are spending on each of them. Finally, we recommend that the association add a revenue general ledger account to the income statement called Collection Legal Expenses Recovery. When the association incurs legal costs pursuing a delinquent owner and receives the legal costs back from the owner as part of the recovery, it can track the recovered legal costs in this general ledger account. This way, the association can easily identify how its attorneys are performing in recovering legal costs from the delinquent owners it's pursuing. Hopefully, this information helps you review, evaluate, and develop an income statement that meets your community association's unique situation and needs.